And happy Thursday, everyone. It is Scott Wohlers with River Place Capital. It is Thursday, December the 15th, and just wanted to touch briefly on what markets did last week as we're going to get into really what has happened in a very loaded economic week this week. So investors were wary of all of the data that they were going to get this week, and you saw a sell-off in the equity markets last week with the S&P 500 finishing the week down 3.37%. The S&P 400, which is the measure of mid caps, were down 4.06%, and the small cap index, as measured by the S&P 600, was down 4.10%. So wary of what was to come with the Fed meeting, if the Fed was going to be too hawkish this week, and you saw the investors sell off. Now, Monday and Tuesday, we had some encouraging rallies ahead of the inflationary data that we got this week. CPI came in less than expectations at 7.1% year over year versus expectations of 7.3%. Encouraging that inflation is continuing to come down. And the hopes were that you would hear out of the Fed Bank maybe some very positive speak of being able to pause soon on rate hikes, and that what they were doing is working, and that inflation was coming down, and that you would see some of that in the equity markets, and you'd see a continued rally till the year end. Well, as the announcement came of another 50 basis points yesterday, which is exactly what the market was anticipating, the Fed released their statement and their dot plot, and they had rates at above 5% for the first time on the dot plot, at 5.1% of where they thought rates needed to be to dampen inflation and bring inflation down. So you saw the market sell off, recover. You saw the markets up into the meeting. You saw the market immediately sell off and then waver back and forth yesterday, finishing down around 0.5%, give or take a couple basis points there on the S&P 500. And we head into today on Thursday, and investors really absorbed the press conference from Chairman Jay Powell yesterday, where he continued to be overly hawkish in his comments about how they really need to bring inflation down quickly, and they need to work hard to do that employment remained too strong, that wage inflation remained too strong, and that he wanted to see those things come down, and that the Fed was going to have to be aggressive until then. And so what you have seen is a reaction in the equity markets on the downside today. Now, what I can tell you is, and what investors are saying is, because the Fed is going to go past 5% to the 5.1%, that the soft landing is no longer going to be possible, whether it was just a slight recession or a mild recession, that we're going to have more of a hard landing. And that's why you're seeing the selling pressure in the equity markets today, is the thesis that the soft landing is gone. Now, there is still a potential for that in 23. I know everybody is in the thesis that we are for sure heading into a recession in 23. I'm not saying that we won't head into one, but there is still a chance that we don't have a severe recession if inflation does continue to come down and the Fed does in fact say and be more hawkish than they have to be. You know, one of the things that came out today is retail sales for the month-over-month comparison was negative, which is not a good thing for the economy. It's not an indication of a continuing growing or very strong consumer base or a lot of consumer confidence. So if you have questions about how to navigate this through the year end, or some strategies to help you navigate through the rest of next year, we'd love to help you position your portfolio to prepare for some additional volatility as we march through all of this. So give us a call. We'd be happy to talk to you. You can reach us at 904-346-3460, or as always, check us out online at www.riverplacecapital.com. I hope everybody has a wonderful rest of your week. Thanks so much.